It is now my esteemed pleasure, extreme pleasure, to bring on Tim Quast, the CEO of Market Structure Edge. Tim.
Neil, it's been a while. Good to see you, my friend. How are you today? You ready for this?
I don't think I'm ever ready. I think I'm ready. I try to prepare my mind, body, and spirit for these events.
Holistic.
Holistic readiness approach. But I always find something new that kind of blows me away. So I'm really excited to hear from you. Now, Tim, you have done these events. You have been present here before. But for the uninitiated, tell us about yourself and Market Structure Edge.
So I have, Neil, wasted my life on market structure, so nobody else has to. That's what I say. So I'm the founder of a couple of firms, two firms, successful quantitative analytics firms that provide data on how the stock market works. So for one, public companies can understand what the money is doing, and for the other, Market Structure Edge, which we'll talk about today, how traders can use the way that the market works to increase the probability of successful trades, and so you can avoid risk. The beginning point for understanding what to do is understanding what's going on. And that's what we're going to talk about today.
Yeah, so I want to say the very first time that I was introduced to you and what you're doing and the tech that you built to support this market structure perspective that you have, every trader on the Benzinga side, like we've got a bunch of like professional traders that work with us or for us and all that. Every single one was like, hey, can you hook me up with Tim, see if I can get a free account? Like, is there any way? Like every single one. You probably have spoken to Nick Shaheen in the past. I don't know if the name rings a bell.
Nick and I trade 2, 3, 4 emails per week.
Oh, okay, great. So yeah, he in particular was very, very interested. And I gotta say, the first session that I talked to you, when you outlined, you just like split, like this is the way the market was composed so many years ago. This is how the market is composed today.
Yep.
Legitimately completely changed the way I was looking at things. And I'll let you, I don't want to, I'll bury the lead a little bit. So I'll let you convey that information. But I gotta say, that's what made market structure one of the top priorities for me in my thought process when entering things. So I'm very excited to see what you have for us today.
Thank you. Well, what we'll try to do here is I'll spend about half the time explaining why meme stocks exist and how you can use that information to improve your trading probabilities, and then we're going to look at real examples, and we'll conclude that way.
Excellent. Sounds good.
I'll try to make it entertaining. You know, it's information is half entertainment, half knowledge, and I'm only half knowledge. So we'll give it our all. Live from my family room in Steamboat Springs, Colorado.
It's a nice room.
Thank you. Steamboat Springs is a lovely place.
It really is. I've actually been there before. It is beautiful. All right, Tim, I'll let you take it away, my friend.
Okay. Thank you, Neil. All right, so I'm going to immediately share my screen to commence this discussion, and you will see my face briefly, and then we'll shift to the data that matters. So here's what I want to do. The purpose for this session, this is an educational opportunity, boot campers, and we want you to understand how the market works. It's an essential part of being successful in anything. You know, if you're going to be a doctor, you got to know medicine. If you're going to be a lawyer, you got to know law. And if you're going to be a trader, you ought to know how the market that you're trading in works. And so we're going to talk about what powers meme stocks. There's been a craze, particularly in 2021, and then how to tap that. How do you tap that power to improve your outcomes? And I'm going to begin with a little story because I like to do that. So there's this character named Basil Fawlty. It's a fictional character created by John Cleese. If you're a Monty Python fan, as I am, he became famous as part of that troupe. Back in the 1980s, I think it was anyway, he wrote this series and starred in it for British TV. It's a sitcom called Faulty Towers. And it's about this guy, Basil Fawlty, who runs a hotel, and he loathes the people who stay at hotels. And in this hotel is a restaurant. And in one episode, the health inspector arrives and begins inspecting the place and is appalled. And he devises a long list, and he reads the riot act to poor Basil about the deplorable state of his restaurant, the decaying food in the kitchen, the cigarette butts in the ice maker. And he hands this list to Basil, John Cleese, and says, "I should shut you down." And John Cleese studies the list and considers it for a bit, and then he says, "But other than that, everything's all right." And so, sometimes that's the way it is with market structure. As we begin, I want to invite you to follow along. So go to marketstructureedge.com, hit that request a free trial button. All you have to do is put your name and email in, and you get a 14-day trial. And when we get to the real world examples, I'm going to show you even what I do. You'll have a chance to follow right along and understand a little bit more about the platform. So let's get to the heart of the matter. We're going to talk about market structure, and Market Structure Edge is a platform for decision support for traders. And it's a fintech company, financial technology, that builds software and algorithms and mathematical models that measure how investors behave. And we've been doing this a long time. The sister company, modernir.com, that I started in 2005. By the way, Edge, I started it last year, 2020, in the pandemic. So it's a brand new platform, but it brings very sophisticated, time-tested technology to the process of trading. Modern IR is the largest provider of quantitative market structure analytics to US listed companies. So a who's who of the market, trillions of dollars of market cap. They use our data to understand what the money's doing. Same thing that you should use Edge for. And we're market structure experts. We're recognized as such in the equity capital markets. I was asked by Congress in 2017 to submit written testimony on how to improve the market for traders and investors and issuers. We're a long time. I'm a 26-year member of my professional association, the National Investor Relations Institute. NERI it's called. And I mentioned this to say that we know what we're talking about here. I may not know other things, but certainly we know market structure, which is, if you say, well, what's market structure? Well, it's a jargon term, but it means the behavior of money behind price and volume in context of rules. There are rules that govern how the stock market works. And it's important that the tools that you use and the perspective that you bring reflect those realities. If you're still operating in 1995, you will fail because the market doesn't work like it did in 1995. In fact, the stock market is the Death Star. For those of you who don't watch the Star Wars movies, we're referring to this massive weapon that the Empire built that looks about like this. And this is not our image. This image was created by the global electronic trading team at T. Rowe Price. I know Met Kanak, who heads that team quite well, have hosted him for panel discussions about market structure, have been on panels with him. And his portfolio managers at T. Rowe Price said, what do you mean we can't buy this or get this quantity of this stock? And why is that, Met? And so Met had his team devise this schematic so that the portfolio managers would understand the limits of what's possible in the equity market. And he said, here's why. And you don't have to know all the details that are on the screen here. All you have to know is that on the left, screen left, is a buyer, and on the right is a seller. And in between lies the Death Star. And this happens in every transaction. In order for buyers and sellers to find each other, they will have to navigate a labyrinth like this, and it will necessarily alter outcomes. It's going to change the way that prices behave. It's going to change the supply of things that are available. And we're going to talk about how those things affect meme stocks. This creates complexity, excessive intermediation. It becomes an end unto itself. By the way, this is the way that the market works. Every dollar that goes into and out of the stock market has to pass through a broker-dealer. You use a broker. They're going to do this very same thing. Virtually, they're going to use algorithms. Virtually all, that's what I was going to say, 95% of trades execute on algorithms. 100% of trades are electronic because we have an electronic market. Those algorithms, even when you hit buy or sell, that will become an algorithm. They're going to pass through what's called a smart order router and then be fed out into the market through what are those DPs you see. Those are dark pools, broker operated trading pools, before they ever get to the exchange. Most of the time, you and I will never even get to the stock exchange. Our orders will terminate in a dark pool someplace, which means some trader gets to it before it ever gets to maybe the best price. That may not matter, but it's important to understand this is going to affect behaviors. And what we find is that there's a very high probability, 90% mathematically, a little better than that, that the market isn't rational. And we're not just saying that, we're looking at the underlying behaviors in the marketplace. There are 4 reasons people buy and sell, not just one. We tend to think that the stock market is a place where investors are meeting each other. Well, that's one reason, but there are a lot of other things that go on. On the left, active stock picking is the story. This is saying NVIDIA is a better investment than something else because it's got a better competitive position, better technology, really smart management, etc. Well, that's 9% of market volume. More than double that is passive investment. BlackRock, Vanguard, State Street, target date funds. What do I want to have is a mix of assets in my 2040 target date asset allocation plan so that I have retirement dollars. That is significantly larger as a motivation than is active stock picking. Stock picking can be part of that, part of an asset allocation plan. Then you get to fast trading. That's 53% of the market, and we're referring to machines that change prices. Citadel, Virtu, Two Sigma, Quant Lab, Hudson River Trading, Infinium, GTS, all these firms, names that you may or may not know, and they're more than half of all market volume, and they don't want to own anything. They change prices. Then you've got on the far right what we describe as risk management, and we do it too, right? We may buy a stock and sell a put or a call. Hedge funds may pair an equity trade in a multi-leg trading strategy with other things. That is 18% of the market. The use of derivatives. These things are continually going on, and only one of those is predicated on rational thought. So that's going to have an effect on how the market behaves. So now let's get to the heart of the matter. We want to talk about meme stocks. Let's start with Gamestop, the original one. And let's suppose, because we want to understand what's going on out there, that GameStop stockholders neither buy nor sell. And of course, they're going to own 100% of the outstanding stock. So if they're not buyers or sellers, how could a price move? A price has to move because there is buying or selling demand, right? That's what happens. So along comes the Reddit mob, perhaps including us, who jam the pipeline of trades with limit orders to buy GameStop. Well, how would the stock go up if no holders who own 100% of the stock are selling? Well, the answer is along come market makers like Citadel and Virtu and Two Sigma and Quant Lab and Infinium and GTS and so on, and they manufacture stock and the stock soars. What should get our attention in this schematic is, what do you mean market makers manufacture stock? That's what we should ask. What does that mean? Why can market makers manufacture stocks? And what do I mean manufacture? Oh, here we're learning about the market. It's very important to understand how it works. Regulation National Market System, Reg NMS, every trader, public company, investor should understand the basics, because this is the regulatory structure of the market. It determines how the market works. Reg NMS regulates quotes, trades or prices, data, and access to all three. And regulators, back when this was fashioned in 2005, implemented in 2007, wanted a continuous auction market. Wouldn't it be awesome if everything was for sale or could be bought at any time? So they wanted a market where there were always 100 shares of everything to buy or sell. That's why we have a minimum bid or offer for registered market makers of 100 shares. 100 to bid, 100 to offer. That's the law. Now consider how this compares to an art auction. What has to what has to exist first at an art auction is art. There actually has to be some piece of art to buy. Then come all of the buyers who must first qualify and demonstrate that they're capable of purchasing the piece of art that will be auctioned. And then an auction commences and somebody wins and somebody owns the art. Well, this is the opposite. Market makers said to the regulators, there's no way we can make a bidder offer in everything without an exemption from the short locate rules. That is, that you have, if you're going to borrow stock and sell it, short it, that you have T+3, trade day +3, 4 days to verify that that's possible. Otherwise, you'll have to buy in. You'll have to buy that stock back. Your agent, your broker, is going to have to be able to find stock. Well, the SEC agreed that, okay, if we're going to have a continuous market, I guess we have to exempt the market makers from that. Thus, short volume is a metric, and we're going to come around to that. It's one of our 2 vital metrics that we use to make trading decisions with Market Structure Edge. So market makers are exempt from Reg SHO, Rule 203b2. You don't have to know that, but it requires everybody else to be able to locate shares, and market makers don't have to do that. Here's what the SEC says. You don't have to read all this. I'm going to hit the high points because this is straight from them. You can go look at that URL. They publish all kinds of information on the rules. Naked short selling is not necessarily a violation of the federal securities laws or the commission's rules, because broker-dealers that make a market in a security generally stand ready to buy and sell the security on a regular, there's that word, and continuous basis at a publicly quoted price, even when there are no other buyers or sellers. All right, I said, if GME has no holders buying or selling, where's the stock come from? Market makers must, not may, must sell a security to a buyer even when there are temporary shortages of that security available in the market. This may occur, for example, if there is a sudden surge in buying interest in that security and they don't have to arrange to borrow shares. That's how it works. So let's now look at Robinhood. I'm reiterating a point here. Robinhood, with 20 million customers, fed the meme stock craze, not by squeezing shorts, and we'll talk about that briefly, but because Robinhood sells its order pipeline. All retail firms do it. They sell their order pipeline to, let's say, Citadel. And let's suppose there are a lot of buy orders and only a limited number of sell orders. So Citadel will immediately buy the sell orders. They don't care, because they know there's a much higher amount of buy orders. Then they will manufacture stock to fill the buy orders, driving the prices of AMC and GME and the rest whooshing up. It is a factory that manufactures stock at ever higher prices. That's how the market works. Then you add this feature to the market. Around that retail pipeline, there is an explosion of changing prices created by the very same firms, the fast traders, Citadel, Virtu, the Hudson River Trading, Quant Lab, Two Sigma, Infinium, GTS, on it goes. And here are data to support that. This comes from IEX Trading, good friends of ours, who operate an exchange, and they studied this data and said, okay, what happens in the 2 milliseconds when bids and offers start to change? Well, at a full-service broker-dealer like Goldman Sachs, not much. How about at an agency broker like Instinet or Themis, firms that don't use their own capital, but they execute trades for customers? Well, there's an increase, but not much. But there is an explosion over here at proprietary trading firms, Citadel, Virtu, Two Sigma, Hudson River Trading, Infinium, GTS, on it goes. I'm not knocking those firms. This is to help us understand how the market works, because this means traders, they know way more than you do about supply and demand. So you need to know market structure so you're not run over by those folks. And we can see all of that. So you're going to hear naked shorting is rampant. Now you know that no, only legal naked shorting by market makers is rampant, because the SEC wants a continuous auction market and they must do it. That's how the market works. Well, you would say, well, what about high short interest stocks? Because it appears that these events occur around stocks with high short interest. Here's a list from Dow Jones Market Watch. This is May 28th data. You may have more current data. The top of the list at this time was Pubmatic, Workhorse, EV company, Clover Health. And this is telling us the percent over here on the right side of the float that is borrowed and sold and not yet covered. Half here. Let's look at Clover, because what we should see is a confluence of the rules and behaviors. And before we get to that, understand short interest. It's a 1974 measure. In 1971, and it wasn't created by the SEC, it was created by the Federal Reserve. under Regulation T. We cut loose from gold in 1971. Financial instrument volatility exploded. People started hedging currency and interest rate risk, margining, leveraging. The Fed thought we're not tracking the money supply accurately. So in 1974, they created this reporting requirement for broker-dealers to tell them about credit use. And that standard has not changed. Think about what has between. Back then, no electronic markets, no ETFs, index funds, high-speed trading, decimalization, Reg MS, best bid and offer. None of that stuff existed, and yet we're still using the same rule. So it's not a great rule. We find almost no predictive usefulness from short interest. In fact, it doesn't matter, really, to meme stock situations. It's a false correlation. It could happen in anything where there is no supply and a surge in demand creates the need for manufactured stocks. But people think this is the case. So here's how we look at this. This is Clover. This is data from Modern IR, and it's how we would present it to a public company. And you don't have to know everything here. The top graph tells us intraday range and where the price closed. And if there are more red lines, there's more selling, green buying, not where it closed, but how it performed relative to midpoint price, because 85% of trades are derivations of midpoint. And then the gray bars are volume. And so here in this rectangle, there was an explosion of volume. Down below are those four behaviors we talked about. And so if the rules hold, then we should see a bunch of orange bars under this explosion of volume, because that's fast trading. Citadel, Virtu, Hudson River Trading, Quant Lab. Son of a gun, there it is. And it's a perfect mathematical pattern. We didn't create that. That's how the data manifested. And then if they're manufacturing stock, then underneath we should see rising short volume. Well, son of a gun, there it is. And here during June, on about the 8th, Clover Health traded almost 700 million shares. It's got 113 million shares in float. 600% increase in volume over the total shares in float. How is that possible? The two things we talked about: manufactured stock and high-speed traders changing the price. And there it is. The behaviors in the market should match the rules. That's how you know if you're looking at things correctly. If they don't, then either the rules are not being followed or we're not measuring things properly. But this can be used to your advantage. The takeaways are: meme stocks result from rules, not the madness of crowds. Sure, madness of crowds helps. That's that surge in buying interest that will lead to the manufacturing of stock. But it's not a short squeeze. It's a surge in supply. Yes, people can get squeezed, but the 0.72s and the millenniums, the sophisticated hedge funds, are going to swap away their short interest in stocks to Goldman Sachs for a fee and take it back when the noise goes away. The unsophisticated ones will fail, and that's what we've seen. Illegal naked shorting is not the cause. Legal naked shorting is. Regulators want a continuous auction market, so market makers must do it. That's the answer. And you might say, well, so what, Quast? What we care about is trading. That's all we care about. Help us trade. Okay, let's do that. Now let's take this knowledge and go over to app.marketstructureedge.com. That's straight to the database. Market Structure Edge will do it. And let's go look at the data. So I'm going to kick out of that and go over here to Market Structure Edge. Bear with me. Okay, so if you went to Market Structure Edge, notice there it is. This is the dashboard. This is what you will see. I use the dashboard to help me understand using market structure sentiment. That's the waxing and waning of supply and demand, and short volume, which we've spent a lot of time talking about, to know when to come and go. So if sentiment is falling in airlines and cruise ships, meaning that demand is beginning to diminish and short volume is way above trend, leave. When the trend line changes and short volume is below trend, now I know demand is likely to exceed supply. So let's go look at the meme stocks. So here we are. We're going to walk through a few of these as we conclude. So looking at BlackBerry, here it is at June 25th, Friday. It's bottomed, about 40% short. Keep in mind a figure. The market is about 45% short. That's your bar. So below that, that's pretty good. Trades about $2,800 at a time. That's liquidity. It's not very liquid. Risk management is the key behavior. That fourth behavior tells us that people are probably buying calls, Well, that could be helpful to know. Maybe the stock will rise. Looking at the data visualizations, here's how we learn entries and exits. You want to buy rising sentiment. When it goes above 5, there is more demand than supply, and that's sentiment, and this is price. Price tends to rise, particularly when short volume is below trend as that's occurring. You know that there isn't enough supply. Short volume is supply. If it's below trend and demand's increasing, price will rise. When short volume rises over trend, probably the increase in price is about finished. And notice that the price did not rise materially further than this. And then demand began to fall and short volume still over trend. Well, the price is going to drop. Now, sentiment is 1 and short volume is above trend. If it ticks up, there may be opportunity in BlackBerry. Now, let's go back and look at behaviors because we want to, again, affirm what we have learned about market structure. So let's go back to June 3rd, which is where this began in BlackBerry at that time, and look at what the data tells. Son of a gun, there's fast traders. The very behavior that manufactures stock. So we know that that's probably occurring. We could go look at the data visualizations back at that time and say, okay, if you were buying it, you would want to buy rising sentiment and falling short volume, and then price rises. And when short volume rises above trend and sentiment is peaked, can't go higher than 10, stocks can continue to be very strong when sentiment is at 10. But then you want to watch the supply side of the equation. And that tells us, okay, well, let's leave. That's how it works. So let's go look at Clover at the same time. Clover Health at the same time, 55% short. It was 9 and an uptrend. Active money leading, hedge funds. Hedge funds were leading at that point because it was early in the equation. So here, once again, it was a 1, short volume below trend. Ooh, rising sentiment, there's an opportunity to buy. Short volume now approaching 60% and over the trend line. Well, you know you're going to be leaving pretty soon because the opportunity for upside is just about done. And that's how you look at it. Let's go to GameStop. And then we'll switch back to current time. Back then, June 3rd, 10 topped, 56% short. Once again, the manufacturers of stock are the leading behavior. By the way, this isn't predictive. It's already baked into this number. We take the 4 behaviors and their effect on price and volume to create sentiment. But this helps us know. We just want to know. Well, there we go. We know that high-speed traders are manufacturing stock. And if we looked at the data visualizations, we'd see that. So now let's go back here to the 25th, and I want to show you 2 things to finish. We're almost finished here. And I don't know, Neil, if we have time for questions, but I want to conclude on 2 quick things here. So number 1, what about a non-meme stock? How about the anti-meme stock? I would say that's Goldman Sachs. It trades almost $18,000 at a time. Very, very liquid stock. And as of Friday, it's a 1.8 and trending up. Sentiment's rising. Short volume is way below 45%. That's pretty good. Passive money's leading. We have month-end window dressing next week, quarter-end window dressing. June 30, very important day for passive money. If futures contract expires, they need to true up their tracking. So I would look at that and say, okay, here's Goldman Sachs, and it's best to own stocks when they're above 5. 5 and above, more demand than supply as a central tendency. When it peaks and short volume is above trend, well, if you wanted to short Goldman Sachs, there's the point to do it because price declined. Now it's a 1. Short volume dropped below trend, sentiment is ticking up. Buy them. This is what we told edge users. We said, well, the data show financials look good. This was last week. I bought JPM because that's what the data indicate. We're using central tendencies and probabilities. That's math, and math tends to serve us well. We can eliminate all the things that don't reflect how the market works. So let's finish with this. We'll finish in space. So let's look at Virgin Galactic, which surged all-time single-day gain for Virgin Galactic, and I bought it and sold it. I'll tell you why. So notice that it's an 8. So it's not a 10 yet. It's an 8 trending up, 50% short. We know shares are being manufactured to fill trades. Sure enough, there's fast trading. It trades about $6,700 a trade. That's not bad. It's top 1,000 in the market. So looking at the data visualizations, here's where it surged above. There's rising sentiment, a whole bunch of manufactured stock that slows the price down, but it tells us that fast traders probably did that. 10. Sentiment begins to decline. It's still above 5. You could continue to hold it. Here's where it ticked up. It ticked up on Thursday. So I bought it Friday morning. because I said, okay, so short volume's right at trend. It's not above it, and demand is increasing. Supply is the same, demand is increasing, ergo, price rises. And I'll show you what I did. So, here's my interactive broker's account. I have way too much to do a lot. I trade about 45,000, 45,000. It's got 45,000 in it at the moment. So you can see what I did. I bought SPCE right at the market, 730. And I couldn't even buy 100 shares. There's no liquidity. It got split into two trades. I didn't choose that. I bought 100 shares. It split into 75 and 25, both executed at Instinet, an agency broker. That's what Island is. Island did 4 of these transactions, and my broker's ATS, Alternative Trading System, executed my JPM trade. None of it made it to the market. And I was intermediated by a fast trader who took a half penny there and a half penny there. Then I sold it. So I bought it at 47.60. I sold it close to 50. I'm happy. It went up to 55.90, but I'm happy. Why did I not stay in it? It's a high risk stock. I'm not staying in over the weekend. I used the probability of rising sentiment and constrained short volume to take a brief profit. That's what I did. And it, works very effectively. That's what I try to do. Avoid losses, produce gains. That's what we want to do. So going back here to conclude, and if I've got more stuff, Neil, I'm just making sure that I'm sticking to the time here. It's just about 10 o'clock Eastern time. Here's the point. If you think about all of this, why does this matter? Well, because it doesn't matter how much your stocks go up if they go down before you sell them. Well, how would you know? You look at charts. How many technical traders do you know are rich? No offense to my cast of fellows here at the Benzinga boot camp. I'm not knocking technical trading. I'm saying it wasn't really designed for the market that we have today. How about reading financials? How about studying headlines? Well, those are useful because at times those things will have an effect, but ultimately it comes back to supply and demand and the rules that govern how supply and demand fluctuate. You want to make sure to capture your gains and as much as possible avoid losses. They can be fluctuating around earnings, around options expirations. We pay very close attention to those things because they alter outcomes. But even so, sentiment will generally tell us. If FedEx has topped at 5 ahead of results, right at the fulcrum of supply and demand, and short volume shoots up 26%, which is what happened before FedEx reported results, what is the likelihood of what happens no matter what they report? And they reported record results. The price will go down. There's more supply than demand, particularly if active money now stops what it's doing to read the financials. High-speed traders will take that stock down. Well, that's stuff you can use to your advantage. That's the whole point. The market is complicated, but edge is very simple. We want central tendencies and probabilities. Market structure, sentiment, and short volume are very simple. They don't change based on price and volume. They will always give you the same valuable input. And there is no perfect system. There is nothing that is perfect. All we can do is try to stack the probabilities in our favor. And I'm telling you, from 20 years of doing this, helping public companies understand how the market works, helping regulators and congresspersons understand it, that you as traders can do it too. And there are very, very wealthy people using market structure. Citadel, Virtu, Two Sigma, Jane Street, a hugely profitable firm. Go read the book by Greg Zuckerman called The Man Who Solved the Market about Jim Simons, founder of Renaissance Technologies. Renaissance Technologies is a bunch of mathematicians. Jim Simons is a math PhD. They're not traders. They made $100 billion using short-term quantitative strategies. It's not about greed. This is about looking around and saying, what works? Well, math works, particularly when there are rules. And what we want is a new way to trade that puts those probabilities in our favor. And that's what Market Structure Edge does. I'm glad you attended the Benzinga boot camp, and thank you for joining me. Neil, if we have time to kill, I can do it. If we don't,
we do.
Okay.
We've got 6 minutes for Q&A, and if you got more content, go. Otherwise, guys, if you have some questions for Tim, which you have to have, drop them in chat. But Tim, there's a little bit of lag on the stream, so I would say give us some more of that sweet content that you have.
And if people say, hey, show me some stock, provided it's in our platform. By the way, the platform focuses on 99.9% of market cap, and that is what's in the Russell 3000. Believe it or not, there are not 10,000 stocks in the stock market. There are 2,000 ETFs, which are all derivatives based on the same underlying stocks that everybody else owns. And there are about 2,500 companies in the Wilshire 5000 index. But that's what we're going to focus on because those are the core. So here's how I'm going to take you to the dashboard then, because this is how you can see the whole market. So what I do every day is I go look at my portfolios. Each of these little squares that you see is a portfolio that I've created. This one's a dynamic portfolio that's going to tell me every day what stocks are 75% short. 78 of them out of 3,500 companies right now are. That's not a whole lot. And then airlines and cruise ships, I created all of these. We will automatically create all sector portfolios for you, starting with communication services. By the way, the big tech stocks, the FANGs are in communication services, consumer discretionary, and tech. They're not all in tech. People don't realize that. Tesla's in consumer discretionary, right? Communication services includes things like Facebook and Twitter. So you have to realize that. Notice this, communication services, sentiment dropped below 5 and is now trending back up, and short volume is down. Well, I'm going to go look at that, right? There could be opportunities in there. That's what I do each morning. I scroll through, and if all the trend lines are down and short volume is rising, I'm out. June 17, I was 100% cash because I looked at all the trend lines and said, I want no exposure to that. I did not lose any money. Then when the trend lines began to improve last week, then I came back. I didn't capture all of the gains, but I avoided all the losses and added to gains. That's what I want to do. I'm not a huge risk taker. I just want high probability mathematical outcomes. And so in the last month, I've made 7%. Well, in 12 months, that's 100% return. It's better than all the professionals. And I don't spend any time doing it. I'm running 2 businesses. So this is what I will do. And what you could do, by the way, is just to click through. I could go in here and the portfolio will tell me which things are the best things to look at the top of the list there. It will tell me, okay, what stuff is 1 and bottomed. I like to see the uptrend. So I'm going to go to the 1.8 and up. And I like highly liquid stuff. So I will be, I'm going to look for things that meet my criteria. Plus, you can always create those. I mean, if I look here, it's Take-Two Interactive. There's a 1.8 trend line is up, 40% short. Fast traders are driving it. So they know there's increasing demand. And if need be, they will create supply to meet that demand. Trades almost $12,000 at a time. Wow, that's a really interesting stock. I mean, that's how it applies to anything. Don't buy here when the sentiment is falling and short volume's above trend. The likelihood that you produce a return is very minimal. Buy when sentiment bottoms and rises. Yes, there's a fair increase here. So it may mean that my cycle is short. Short volume that rises very quickly, just sentiment's beginning to rise, may shorten your cycle. But it still tells us that high-speed traders are manufacturing shares for buyers that will create an upward bias for a brief period. Capture it and leave. And we always create the opportunity to backtest your data. There are 5 easy rules for understanding market structure edge. Number 1, understand the dashboard, just what I've been showing you. Number 2, create portfolios. Very simple to do. Number 3, learn entries and exits. Number 4, backtest your data. I always do that. I'm still going to go look at Take-Two in my profiler to backtest and make sure that the probabilities in the past buying an uptick will work. We say buy ones, buy an uptick, buy the rise over 5. Sell a reversion to 5, sell a 10, sell a downtick, or some mix of those things is always going to, and if you can't find a return, look for something else. Profiler will tell you that you're not getting good returns. Rule number 5, easy step number 5, manage overall risk. This is why only half my money's in the stock market right now. Sentiment is at 4. So the market trades between 4 and 6. The red line tells us the market is topped. Here's where I began to leave. Why did I do it? Because sentiment was topped. So by here, I'm out. So I missed all of these declines. And then as the sentiment declined back toward 4, now I will put more money to work. I didn't capture this full bounce, but I'm capturing very nice returns. That's how I use it. When it's topped, I remove my money or a good bit of it, and I'm very selective. When it's bottomed, then I put more money to work. If it reverts and begins to rise, I'll put the other 22,000 or so that I've got sitting in cash back in good stocks with rising sentiment and falling short volume. That's what I'm doing over and over and over, and it's very reliable. Okay, Neil,
Tim.
I know I've exhausted my time.
Yeah, you're exactly on time. Really good stuff. So we're getting questions about the subscription, about specific stocks, but we are at time. So Tim, I think the best solution is to give folks the instructions on exactly how they can get more from you and Market Structure Edge. Where do we go?
So our subscribers know I give my email out. It may take me a week to reply to you, but you can ask me anything. I spend a good bit of my day responding. TQ@marketstructureedge.com. Send me a note. Our subscriptions are it's roughly $100 a month. And you say, well, that's pretty expensive. Not if you make $200 per trade, which I made $650 trading Virgin Galactic, just 100 shares of it in an hour. So you should make those returns very easily. Thank you, Neil. TQ@marketstructureedge.com, and marketstructureedge.com is the platform. Good
Wonderful.
to be with you.
Yeah, it's always great. I love your platform. I love the technology. I love how it changes the way that we look at trading in general. I have a show on Benzinga called Get Technical on the YouTube, and gotta say, I think the future looks dim after this presentation. So Tim, thanks for coming on and giving me a warning.
You got. I'll see everybody, and Dennis Dick and Joel Elkanan and Spencer Israel. Market Structure Monday, and we'll talk more about market structure. We got stuff to tell you. It's very important stuff. So come join that. Yep.
Pre-market hours, Benzinga YouTube, Tim every Monday, Market Structure Monday. Let's go. Yep. All right, Tim, thanks for being with us, man.
Thank you.